Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing a weekly market update. We try to bring this to you every week from the Cronford Market Report. That's our local guru, people that do all the assessment on where the housing market is. They've been doing it for years and years and years. And here it is for this week. What I'm going to concentrate on are a couple things. The first one is rentals. Um, Rentals are really an effective way to kind of track what's going on in the market because they happen a little bit quicker typically than you close on a house maybe in 30, 60, even up to 90 days sometimes now, with some of the different terms that people are going after. So with rentals, it's kind of more of an immediate thing where people are closing and signing leases right away. So what we're looking at is not as much of a lag here with the rental market to maybe indicate what's going on. So when we look at listings, we see that listings, the amount of listings, the number of listings coming on the market has gone up 44%. So prices are kind of leveling off or going down in a lot of areas. And overall, we were at the beginning of the year, around 108, I'm sorry, a buck 80 a square foot. Now we're down to a buck 69 a square foot. So that's about a 6% drop on return. As far as investors are concerned, it's good news for renters, but not so much for investors. Okay, still a great return on your investment, of course, at that level. But we see kind of maybe a little shift happening here. And again, we're going to keep tracking this. We kind of talked about this a little bit about 2 or 3 weeks ago. But, from a year ago, we see that the rental prices have actually gone down a total of 15% this time last year. So that was around buck 99 a square foot about a year ago. So now it's down about 15%. So there's, you got all these extra new listings hitting the market. Now it kind of slowed down or stopped back in August of 2021. So now we're seeing this huge influx of new rental listings coming on the market. And part of that could be, people maybe selling some of these properties off, thinking that, they've gone up enough. They're maybe a little bit afraid of a crash coming, which we've already talked about many times because of the regulations, because of the, compared to when we had the crash last time, because of the supply and demand issues that we're having. We just don't have the supply or oversupply and the builders building the homes like we did back then. And back then, when we had the crash, people could fog a mirror and buy 3 homes. Like literally, if you watch The Big Short, it was pretty much put out there that, people even like strippers and stuff were buying 3 homes at a time. So right now you don't really have that freedom of just finding a mirror and buying a home. There's a lot of things that go into getting pre-approved to even buy a home, to get a home loan in the first place. So we're not seeing that. Also, we see people have tons of equity, even compared to back then. But we just don't have that overbuilding of builders, that oversupply of homes like we did back then, as opposed to now. However, we do see maybe a little bit of a weakening here in the market. What does that mean? It means we may get to more normal levels, and that's all it means. It doesn't mean we're going to crash. It just means that we may end up heading eventually to normal levels. Instead of having 5, 6, 7,000 homes for sale in the market, a normal level would be more like at least 20, but 25 to even 35,000 homes for sale at any given time in the valley, in the greater Phoenix area. So does this translate to sales? Well, we'll see. But here's some indicators that things may be weakening a little bit. And again, doesn't mean we're going into a crash. It means that things may level off. So instead of 32%, like this, last year, 32% appreciation, we may have more historic numbers where we're like 5, 6, 7% or 8%, not yet, but in the near future. So, like the Cronford report told us, even if, we were to go into the worst of economic times, a recession or even a depression, it would take several quarters, so at least 3 to 4 quarters at least, to get to the point where we're in a leveled off balanced market. Now, talk about this all the time. What is a balanced market and how does this translate into the numbers? Well, we talk about the CMI, the Crawford Market Index, that tells us where we are. And I try to do this for you weekly so that you can stay up on this every week, because numbers do change. And interest rates and the cost of homes, of course, is going to affect this. And interest rates have gone up quite a bit. And they're talking about interest rates maybe going up another half a point, this week. So this next week. So here's what we want to take a look at. Right now we're at 438. Now earlier this year we were at 475, in the 450s, but it's been dropping steadily. And we've seen this little steady drip of it dropping on the CMI index. And again, it's 438. So what does that mean? Well, I explain this every week, but Crawford Market Index, if it's at 100, that's a balanced market. Okay, or in between that 100 or down to 90 on the index, or up to 110. 90 or below, you're going into a buyer's market. 110 or higher, you're going into a seller's market. And that 110 and within that range to 90 to 110, you're in a balanced market. So overall, right now we're still at 438 across the board in the greater Phoenix area. That means we're still in a very, very strong seller's market. However, we're seeing a weakening. there. Last month, from month to month to now, we saw a decrease of 6.4%. And week to week, we've seen a decrease from last week, down 3.2%. Okay, so the only cities that did not decrease were Gilbert, Cave Creek, Gilbert, Maricopa, and Tempe. Gilbert, Maricopa City, and Tempe. They all went up. So I'm going to show you a chart here in a second, but so we see this ticking down, but it's still very strong. So let's look at the supply and the demand. The supply is at 24.25%. Okay, so we're still below supply. The supply just kind of hangs there. It's been hanging in that same range for a while. We're still below on our supply by 76% below where we should be on our supply, but our demand is 106.3. So now that's actually kind of in getting into more of a normal range there on that demand. Okay, and again, that's because rates continue to escalate along with prices. Okay, so if you're going to buy a house, do it sooner rather than later. And if you're going to buy if you're going to buy a house, to get that better price, you may even want to think about selling a house, even if you're not buying. And if you are going to buy and sell, then you may want to think about it too. Why? Because the interest rates are higher. For every 1% uptick on an interest rate, you're looking at about a 10% increase in your monthly payment, or 10% decrease in your buying power. Okay, so let's take a look really quick here at let me see if I can do a shared screen here. There we go. Okay, all right, so we have so if you look at the red arrows pointing down on this chart, this will show you all the areas that are going down. So we got Fountain Hills is down 15%, Avondale is down 8%, and this is on that CMI index, the Crawford Market Index. Okay, there's still, Fountain Hills is still at 569, Avondale still at 552. Scottsdale is down it's down to 517, which is a 5% increase. But let's take a look at some of the bigger numbers here. The biggest number is Cave Creek, went down 19%, but it's still at 462, but it went down 19%. There's some other ones here, but let's jump down to Surprise. That's down 14%. Okay, but we're still at 394, still high. Again, anything over 110 is a seller's market. And Buckeye went down 14%, and that's still at 252. So just wanted to kind of give you, an idea here on where we were, and what, things look like. again, it's a weakening. It's not a, oh, whoa, hurry up and run out there. But with interest rates going up, it may be time to start, looking at this a little bit closer and keep an eye on it. And probably, things will start leveling off a little bit more. It's just basically what is happening is people in that, two, three, $400,000 range are just having a real tough time buy a house, even up to 500,000, which used to be our luxury market. They're just having a real tough time buying a home because interest rates are so much more expensive now for them to purchase a home, and the prices have just basically in the last couple of years, just doubled. So in any case, if you guys have any questions at all, want to know more about your area, want to know more about your home value, want to get pre-approved for a home loan, even want to refinance, cash out, refi, whatever the case may be, I will be happy, and my team will be happy to go over that with you and get into the weeds a little bit more with you on that. But you can always reach out to us at mincolahomes.com, mincolagroup.com, or 480-788-8569, or home@mincolagroup.com. See you guys next time. Thanks.